Welcome to ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis.
And I'm particularly excited to dive in tonight. It's late night, 11 p.m. Eastern, 8 p.m. Pacific on Wednesday, September 3rd. And what a day it's been in the financial world.
It certainly has lots to unpack.
Absolutely. This deep dive is packed with critical insights from, well, all across the globe, giving you a shortcut to understanding the forces shaping markets right now. We'll look at the surprising winners and losers in the U.S. stock market, dissect the latest employment data and what it means for interest rates, and even find out how tariffs and corporate governance are playing out from Japan to India.
It's a truly fascinating mosaic of global finance, that's for sure.
And I can't wait to uncover what truly moves the needle. Okay, let's unpack this then. Some huge news from the tech world dominated headlines today. Alphabet, Google's parent company.
Right.
They had an absolutely massive day after a U.S. court antitrust ruling. It seems they managed to avoid a forced divestiture of Chrome, their web browser.
Which was a huge overhang for them.
Exactly, a really high-stakes case. And this sent their stock surging, temporarily hitting a record high, up a phenomenal 9.2%.
Quite a jump.
Yeah, and analysts from Bank of America and Wedbush immediately raised their target prices. They're pointing to significantly reduced regulatory risks and a renewed confidence in Google's search dominance.
Especially with their AI advancements.
Right, especially with its robust AI capabilities, like those new AI overview features you see appearing in search results now.
Those are key.
And what's intriguing is that Apple also saw a rise of over 3%. Apparently because the court didn't prohibit Google from paying them for Chrome pre-installation.
Which was a potential downside risk for Apple.
Yeah, so that removes a significant risk for them and keeps their negotiation flexibility wide open. This just feels like a monumental decision for the tech landscape.
This ruling for Alphabet is indeed a monumental moment, and the critical insight here is understanding why avoiding that corporate breakup was so crucial.
Right.
It protected Google's fundamental business model. I mean, imagine the implications of divesting Chrome. It's not just about selling off a web browser.
Yeah, it's more integrated than that.
Exactly. Chrome is a critical gateway into Google's entire ecosystem, its search engine, its advertising platforms, its data collection apparatus.
Okay.
Fragmenting that would have severely disrupted their ability to integrate services, collect the vast amounts of data they need for refining their algorithms, and continue innovating.
I see.
So this decision essentially affirms their integrated strategy. It allows them to keep investing heavily in core areas like artificial intelligence without that threat of a forced separation hanging over them.
And those AI overview features you mentioned.
They're a perfect example of this integrated strategy in action. They demonstrate how Google can leverage its advanced AI directly within its most dominant product, search, reinforcing its competitive moat.
Right.
So for investors, this ruling provides invaluable clarity. The regulatory environment has been a source of uncertainty for big tech for a long time.
Yeah.
Reduced regulatory overhang, well, it often translates directly into enhanced investor confidence. We saw that instantly in the stock price surge and the positive analyst adjustments.
Okay.
It suggests the market now sees a clearer path forward for Google's growth, free from this particular legal cloud.
That court ruling is clearly a huge relief for Alphabet, removing a major overhang. But I'm curious, how much was the market genuinely pricing in a breakup scenario? Was that like a real possibility?
Well, the market was indeed pricing in a significant regulatory risk. A full breakup of Chrome was probably seen as a lower probability, high-impact tail risk, maybe.
Tail risk, okay.
But still, the uncertainty alone, that was definitely a drag on the stock.
And what would the unforeseen ripple effects have been across the broader tech landscape if Chrome had been divested?
Oh, the ripples would have been profound. You would likely see a scramble among other browser developers. Think Brave, DuckDuckGo, maybe even Microsoft Edge trying harder to gain market share.
Right, more competition.
Potentially leading to a more fragmented user experience, perhaps. But also, critically, a disruption to Google's advertising revenue. That's the engine for so much of its innovation. It could have even forced Apple to reconsider its default search engine strategy, opening up new opportunities for rivals like Microsoft's Bing or others.
That's interesting.
The long-term impact on the entire digital advertising ecosystem and the innovation cycles within it, honestly, it would have been pretty unpredictable.
Okay, and shifting to Apple's side, while the court didn't prohibit the payment, for a casual observer, it still looks like a dominant player maintaining its position through, well, financial leverage.
Yeah,
You know,
I understand that perception.
is there a philosophical or legal distinction here that truly sets it apart from more overtly monopolistic practices?
Those are incredibly probing questions, and they really get to the heart of modern antitrust debates. You've identified a very fine line.
Yeah.
From a philosophical standpoint, it certainly raises questions about how truly organic market dominance is when these kinds of payments are involved.
Right.
However, the legal distinction, as the court likely interpreted it, it revolves around whether these payments exclusively lock out all competition in an anti-competitive manner.
Okay, so exclusivity is key.
Yes. Or if they represent a legitimate commercial agreement where Apple, as the platform owner, retains the agency to negotiate. The court's decision suggests that Apple still has negotiation flexibility.
So they could choose someone else.
Theoretically, yes.
Hmm.
If a better offer or strategic fit presented itself, it's not seen as an absolute shutting out of competitors, but maybe more like a preference bought in a competitive bidding process.
Hmm.
The legal framework focuses on preventing abuse of market power that stifles innovation and consumer choice. And in this specific instance, the court seems to have found that the current arrangements don't cross that threshold into illegal monopolization, at least not in the way a forced divestiture would address.
Okay.
It's a continuous balancing act, really, between allowing companies to compete aggressively and preventing them from becoming anti-competitive.
That's a really fine line you're drawing there. But for a skeptic, it still sounds like Google is kind of buying its way into market advantage. What truly prevents this from ultimately stifling the kind of organic innovation we'd hope to see in a truly competitive browser market?
Well, that's the ongoing debate, isn't it? The hope, I suppose, is that the sheer pace of technological change and the continuous emergence of new competitors, even if they're small.
Like the privacy browsers you mentioned.
Exactly, or new search paradigms, things like that.
Yeah.
The hope is that these will prevent complacency. Regulators will also continue to monitor these agreements very closely, you can be sure of that.
Okay.
But your point is valid. When market leaders have such deep pockets, it undeniably raises the bar, makes it harder for challengers, no question.
Okay, that makes sense.
Yeah.
So while Alphabet soared, we saw some pretty mixed signals from other tech players. Salesforce, for example, fell over 5% in after-hours trading.
Right, that was quite a drop.
Their Q3 revenue forecast missed market expectations, which apparently raised concerns about how much they're actually benefiting from their AI investment.
Even though they talk a lot about AI.
Right. And oddly, their Q2 earnings actually beat estimates, driven by AI agent contracts and subscription revenue. They even announced a huge $20 billion share buyback expansion.
Which usually signals confidence.
You'd think. Then there's C3.ai, which plunged nearly 12% after withdrawing its full-year forecast and reporting weak Q2 sales, missing expectations. They also just got a new CEO.
A lot going on there.
Yeah. On the flip side, Hewlett-Packard Enterprise, or HPE, rose nearly 2% after raising its full-year forecast.
Interesting contrast.
Their Q3 sales beat forecasts, largely driven by a server revenue increase, partly due to the Juniper Networks acquisition, and crucially, AI server demand.
Ah, the hardware side again.
Exactly. And then there's Polestar, the Swedish EV maker. They absolutely plunged 17.2%. Their net loss widened significantly, and they didn't even provide a full-year forecast due to market uncertainties, tariffs, policy changes, U.S. sales being particularly challenging. It's a real mixed bag out there.
It really is, and this highlights a crucial distinction in how the market is currently viewing AI investment benefits. It's becoming clearer.
How so?
Well, one compelling takeaway is that companies providing the foundational infrastructure for AI, the hardware, are seeing immediate, tangible returns. While those trying to integrate AI into their software or services for customers, well, they seem to be struggling more with adoption and monetization.
So like selling the tools versus using the tools.
Precisely. HPE's rise is a perfect illustration of the pick and shovel play during a tech gold rush. They're selling the AI servers, the hardware that powers the whole AI boom.
Okay.
Their demand is direct. It's less dependent on the success of any single AI application. They profit from the sheer volume of AI development happening globally. It's a more straightforward path.
Right.
Conversely, Salesforce, despite touting those AI agent contracts, is finding that the revenue growth isn't accelerating as much as the market hoped or perhaps expected. This suggests that while they're making inroads, the broader, scalable monetization of their AI offerings isn't quite living up to investor expectations yet.
Why is that so hard?
It's a common challenge for software companies. Developing powerful AI features is one thing, but getting enterprise clients to fully adopt them, integrate them into their workflows, and, crucially, pay a premium for them at scale. That's another challenge entirely.
Okay, so adoption is the bottleneck.
Often, yes. And C3.ai's situation looks even more challenging. There's significant plunge, withdrawing forecasts, weak sales, compounded by internal strategic changes and a new CEO. It signals deep-seated issues beyond just AI adoption.
Yeah, sounds like more fundamental problems.
It suggests that simply having an AI-focused business model isn't enough. Execution, clear profitability, consistent growth, those are paramount.
I'm Polestar. That seems different again.
Right. For Polestar, their dramatic plunge isn't just about AI. It's a confluence of global economic and competitive factors. The EV market is intensely competitive right now.
Price wars and stuff.
Exactly. Price wars are becoming common. On top of that, Polestar faces increased sales costs from tariffs, particularly in the U.S., which is about 9% of their total sales.
Okay, tariffs hitting them hard.
These external headwinds, combined with broader market uncertainties, have made it impossible for them to provide a full-year forecast. And that's always a red flag for investors.
And the Salesforce buyback didn't help.
Well, their $20 billion share buyback expansion, while substantial, ultimately failed to reassure the market. While buybacks typically signal management's confidence and can boost earnings per share.
What?
But if the underlying growth story isn't strong enough, or if there are concerns about the efficiency of capital allocation compared to other investment opportunities, well, even a large buyback can be overshadowed by missed revenue forecasts and broader market skepticism.
So investors want real growth, not just financial maneuvers.
Exactly. It shows investors are looking beyond simple financial engineering for genuine, sustainable growth.
It seems like AI is this magical buzzword everyone's throwing around, but clearly some companies are winning with it and others aren't. What's the fundamental difference between using AI effectively and actually profiting from it in a way that investors truly reward? Is it just about being an AI pick-and-shovel provider versus trying to sell AI-powered software?
Yeah.
Or is there more to it?
That's a profoundly important distinction, and it's precisely where many companies are either thriving or, well, stumbling right now. You're right to identify the pick-and-shovel providers like HPE.
Selling the tools.
Yes, they sell the foundational tools, the servers, the specialized chips, the data centers that everyone needs to build and run AI. Their business model is more like a utility in a way.
Okay.
They profit from the sheer volume of demand for AI infrastructure, kind of regardless of whether a specific AI application succeeds or fails.
Yeah.
Their path to profitability is more direct, maybe less risky.
Makes sense.
However, for companies trying to apply AI, like Salesforce with its AI agent contracts, or C3.ai's enterprise software, profitability is far more complex. It's not enough to just embed AI into a product.
What else do they need?
They need to demonstrate how their AI solutions deliver measurable, superior value to customers. They need to solve a genuine business problem that justifies a significant expenditure. And then, crucially, they need to scale that adoption.
Scale it up.
Yes. This means proving a clear return on investment, or ROI, for their clients, ensuring seamless integration into existing workflows, and building robust sales and support channels.
That sounds like a lot more work.
It is. The challenge often lies in that last mile, bridging the gap between cutting-edge AI technology and practical, profitable business solutions.
Okay.
So while the pick-and-shovel players benefit from the buzz around AI, the application layer companies need to demonstrate undeniable business impact to truly profit and gain investor confidence. It's definitely a higher bar to clear. It requires strong product-market fit and really efficient execution.
Okay, moving from individual companies to the broader economy, we've got some interesting, maybe even concerning signals coming out of the U.S.
Yes, the macro picture is definitely getting attention.
The July JOLTS report, that's the Job Openings and Labor Turnover Survey, it showed job openings fell to 7.181 million. That's below expectations and the lowest level since September 2024.
A noticeable cooling there.
Yeah, it feels like a pretty significant drop. Meanwhile, the Federal Reserve's Beige Book, which summarizes economic conditions across its 12 districts.
A qualitative snapshot?
Right. It reported that economic activity in most districts showed little or no change. But most strikingly, it noted that consumption was flat or decreased.
That's a key takeaway.
And many households are saying their wage growth just isn't keeping pace with rising prices.
The inflation tinge.
Exactly. We're also seeing increased hiring hesitancy and layoffs in some districts, and even automation and AI deployment leading to natural attrition.
Structural shifts happening too.
It even mentioned a decrease in immigrant workers impacting the construction industry in half of the districts. Plus, inflationary pressures are still bubbling, prices rising moderately, and tariffs specifically pushing up raw material costs,
Tariffs again.
leading companies to expect continued price increases. It feels like the economic picture is getting more complicated, not less.
You've captured the complexity perfectly. And the critical insight here is understanding why that JOLTS data is such a crucial barometer for the economy.
Why is it so important?
It's not merely a backward-looking statistic, it's really a leading indicator of future labor demand. When job openings consistently decline, it signals a cooling in the labor market. It suggests employers are becoming more cautious about expanding.
Pulling back on hiring.
Exactly. Historically, sustained drops in JOLTS can precede broader economic slowdowns or even recessions as companies pull back on hiring before they start, widespread layoffs. It's kind of the canary in the coal mine for employment.
Okay, that makes sense.
And the Beige Book's observations about consumption, well, they really connect these abstract numbers to the lived experience of, you, our listeners.
How so?
Think about your own household budget. If your grocery bill keeps climbing, your rent goes up, the cost of daily essentials continues to outpace any wage increases you might be seeing,
You start cutting back.
you inevitably start to pull back on discretionary spending. You might delay a big purchase, eat out less, or just become far more judicious with every dollar.
Right.
That's precisely what the Fed districts are reporting. A squeeze on household budgets leading to flat or decreased consumption. And that's a significant drag on economic growth, given consumer spending is such a primary driver of the U.S. economy.
Okay.
The mix signals flat overall activity, but these underlying pressures from tariffs, automation, labor supply issues, it makes this a really challenging environment for policymakers. It's not a simple uniform slowdown, but a highly nuanced and potentially uneven deceleration across different sectors and regions.
So, fewer job openings and people not having enough money for rising prices. For our listeners, the immediate question might be, does that mean we're heading for a recession? Is that what this points to?
That's the million-dollar question, isn't it?
Yeah. And we often hear about tariffs in abstract trade terms,
Yeah.
but they clearly have a very tangible impact. How quickly and through what specific supply chain mechanisms do those hidden taxes filter down to something as seemingly mundane as the price of a new sofa, impacting household budgets directly?
Those are excellent questions, the ones many people are asking right now. The softening labor market and diminished consumption certainly raise the risk of a recession, but it's not a foregone conclusion.
Not guaranteed.
No. Central banks like the Fed monitor these early signals precisely so they can adjust policy and potentially engineer a soft landing where inflation cools without triggering a severe economic contraction.
That's the goal.
That's the goal. It's a delicate balancing act, though, like guiding a large ship through very choppy waters.
Okay. And the sofa, how does that work?
Right, your new sofa. That's a perfect illustration of how tariffs ripple through the entire supply chain and hit the consumer directly. Tariffs are essentially taxes on imported goods.
Okay.
Let's say your sofa uses specialized fabric from Southeast Asia, maybe a wooden frame from a European supplier, various components from China.
A global sofa.
Laughs slightly. Very global sofa, yes. If the U.S. imposes tariffs on any of those imported materials or finished components, the cost for the sofa manufacturer to acquire them immediately goes up.
Okay.
They have a few options. Absorb the cost, which cuts into their profit margins. Find alternative suppliers, which can be costly and time-consuming.
Or pass it on.
Or most commonly, pass at least some of that increased cost onto the retailer, who then passes it on to you, the consumer, in the form of a higher retail price for the sofa.
And how fast does that happen?
This process can happen quite quickly, sometimes within weeks or months, depending on inventory cycles and contract terms. So, yes, tariffs act as a hidden tax on imported goods,
Making everything more expensive.
making everything from basic raw materials to finished products more expensive, directly affecting household budgets and contributing to broader inflationary pressures. It's a very tangible connection between global trade policy and your living room furniture.
That makes the tariff impact incredibly clear. It really is a pervasive force. Now, with all this softening data and these inflationary pressures, what's the Fed saying? And how are the bond markets reacting?
Big questions.
We heard from Fed Governor Waller, who expressed support for resuming interest rate cuts in September. He even reiterated that when a labor market deteriorates, it happens quickly.
A strong warning signal from him.
He also hinted at multiple rate cuts over the next 3-6 months. Unsurprisingly, FedWatch indicated the probability of a September rate cut rose into the mid-90% range.
The market heard him loud and clear.
Yeah. The U.S. bond market saw Treasury yields fall after the JOLTS release, with the 10-year Treasury note yield ending at 4.21%. But before that, the 30-year bond yield briefly touched a key level of 5% due to fiscal concerns.
That 5% level definitely raised some eyebrows.
And this was partly exacerbated by a U.S. Federal Appeals Court ruling that the Trump administration's reciprocal tariffs were unconstitutional. If upheld by the Supreme Court, this could shrink government revenue and expand the fiscal deficit.
The sequence of events perfectly illustrates the rapid, interconnected nature of financial markets and central bank policy, the weaker economic data we just discussed.
The JOLTS, the Beige Book.
Right, particularly the JOLTS report signaling a cooling labor market and the Beige Book's consumption concerns that actually gives the Federal Reserve more justification, more flexibility to cut interest rates.
Okay, so bad news is good news for rate cuts.
In a way, yes, this is a classic central bank response. They use rate cuts to try and stimulate borrowing, investments, spending, effectively injecting liquidity and confidence into the economy to prevent a deeper downturn.
Right.
Governor Waller's comments are particularly significant because he's a vocal and influential member of the Fed. His signaling of multiple rate cuts over the next 3-6 months is a strong forward indicator that the Fed is shifting its stance.
Moving towards easing.
Moving away from its tightening cycle and towards easing, yes. The market immediately priced this in, hence the FedWatch probabilities for a September cut soaring.
And the bond market reaction follows that.
It's a direct consequence. When expectations for lower interest rates rise, bond yields typically fall. Existing bonds with higher fixed yields become more attractive.
Okay. And that 5% yield on the 30-year, why is that so significant?
A 5% yield on a 30-year bond is a major psychological and financial threshold. For the government, it signifies significantly higher borrowing costs over the long term.
Makes financing the debt harder.
Exactly. More expensive to finance the national debt, which already faces substantial fiscal concerns. And for other investments, a 5% risk-free benchmark means that corporate bonds, mortgages, even some equities need to offer a substantially higher return to attract capital.
So it affects everything else.
It impacts a wide range of asset valuations and the overall cost of capital in the economy.
And the tariff ruling adds to that.
Yes, the fiscal concerns you mentioned, particularly the court ruling on reciprocal tariffs, add another layer of complexity. If that ruling is upheld, it could mean a substantial loss of government revenue.
Less money coming in.
And potentially even the need to refund previously collected tariffs, further expanding the fiscal deficit. This kind of fiscal instability can make investors demand higher yields for holding government debt.
Because it feels riskier.
Precisely. They perceive a greater risk to the government's ability to manage its finances responsibly. So we're seeing this intricate dance between economic data, central bank communication, fiscal policy, and these really rapid market adjustments.
That's a really clear breakdown of the forces at play. If the Fed cuts rates, the immediate thought for many of our listeners might be, does that mean my mortgage will get cheaper? Or at least new mortgages will?
That's certainly the hope for many borrowers.
And what exactly are reciprocal tariffs anyway? It sounds like something out of a trade war novel, like you said before.
Absolutely. The expectation for many is that their mortgage costs would indeed respond. If the Federal Reserve cuts its benchmark interest rate, the federal funds rate,
Right.
it generally leads to a ripple effect across the entire financial system. Banks' cost of borrowing decreases, and this is typically passed on to consumers and businesses.
So lower rates on loans.
Lower interest rates on various loans, yes, including mortgages, auto loans, business credit. So for those looking to secure a new mortgage or maybe refinance an existing one, a series of Fed rate cuts could certainly translate into cheaper borrowing costs.
Making homeownership more affordable, maybe.
Potentially more affordable or freeing up cash flow for current homeowners.
Okay. And the reciprocal tariffs.
Right. Your trade war novel analogy still holds, unfortunately. In essence, it's a retaliatory trade measure.
Like tit for tat.
Exactly. If country A imposes tariffs taxes on goods imported from country B might then respond by imposing its own equivalent tariffs on goods imported from country A. The idea is to create a symmetric cost or disadvantage for the other party, often with the goal of forcing a renegotiation or a lifting of the initial tariffs.
And the Trump administration used this.
Yes, they used this approach, arguing for a level playing field by mirroring the tariffs imposed by other nations on U.S. goods.
And the court ruling.
The federal appeals court ruling you mentioned, suggesting these specific reciprocal tariffs were unconstitutional, challenges the executive branch's authority in implementing such trade measures.
So it has bigger implications.
It could have significant implications for future U.S. trade policy and, as we discussed, government revenue, since these tariffs were indeed a source of income for the Treasury. It's a complex area where legal precedent, economic policy, and international relations all intersect.
So the U.S. is grappling with its labor market and the Fed. But this isn't happening in isolation, right? Global markets are feeling the ripples.
Absolutely. Nothing happens in a vacuum in finance anymore.
We saw European government bond yields decline on September 3rd. German 10-year bonds led the way, falling by nearly 0.04% to the low 2.7% range.
Following the U.S. lead there.
Yeah, French and UK yields also dropped. Interestingly, though, the UK's 30-year bond yields briefly hit a 1998 high, around the mid-5.7% range,
That caused some nervousness.
due to concerns over fiscal discipline and loosening bond supply demand. But then they calmed down after the autumn budget date was set for November 26.
So a bit of certainty helped.
And Bank of England Governor Bailey even commented that the surge in UK ultra-long bond yields is receiving too much attention. He attributed it more to a structural decline in demand and shorter issuance maturities by the government rather than solely fiscal anxiety.
Trying to manage expectations there.
He also plans to slow quantitative tightening, or QT.
This entire segment really underscores the profound interconnectedness of global financial markets. A signal in one major economy can send tremors across others.
Definitely feels that way.
Let's first clarify fiscal discipline. It refers to a government's commitment to managing its finances responsibly, spending within its means, ensuring debt levels are sustainable.
Being responsible with the national credit card.
Slate checkle, that's
Yeah.
one way to put it. And having clear, credible budget plans that instill investor confidence. When investors perceive a lack of fiscal discipline, they demand a higher premium, meaning higher yield or lower bond prices, to compensate for the increased risk of holding that government's debt.
Which is what happened with UK bonds.
Precisely what pushed UK 30-year yields to those alarming 1998 highs. It signaled a serious concern about the UK's long-term financial health.
Okay.
The announcement of a concrete autumn budget date helped calm the market by providing a clear timeline for transparency and accountability. It offered a sense of forward guidance that eased immediate anxieties.
So knowing when helps.
Certainty often helps markets, but the broader point is how U.S. economic signals, like the JOLTS report and the expectation of Fed rate cuts, can trigger a bond rally in the U.S. that then spills over into European markets.
Like a domino effect.
It's like a global tide. If the U.S. bond market sees increased buying driving yields down due to expectations of easier monetary policy, that positive sentiment and capital flow often extend to other developed markets. It provides a temporary reprieve from local selling pressures.
Okay. And Governor Bailey's comments.
His comments about the UK bond yields are a nuanced but crucial distinction. He's trying to differentiate between a reactive market panic driven by immediate fiscal anxiety and maybe a more gradual structural shift in demand for those ultra-long bonds.
What kind of structural shift?
Well, if demand for those long-dated bonds is structurally declining, perhaps due to changes in pension fund strategies or regulatory shifts, and the government is issuing shorter-term debt, it can create a supply-demand imbalance at the ultra-long end.
Pushing yields up for technical reasons.
Pushing yields up without necessarily implying a catastrophic loss of fiscal credibility. His plan to slow quantitative tightening, QT, where the Bank of England sells off bonds it previously bought, that would also help by reducing the net supply of bonds in the market, potentially easing some of that selling pressure. It's a strategic move to manage market expectations and provide stability.
Why do global bond yields move together so often, even if countries have their own distinct economic problems?
It really feels like one big connected machine, and sometimes it's hard for our listeners to tell what's local noise and what's a global trend.
That's a fantastic question. And it's because, in many fundamental ways, the global financial system is one big interconnected machine. Think of it as a vast global search for yield and safety.
Okay.
Large institutional investors, pension funds, sovereign wealth funds, hedge funds, they're constantly comparing investment opportunities across different countries. They're looking for the best risk-adjusted return.
So money flows where the return looks best.
Exactly. If, for example, U.S. bonds become more attractive due to falling interest rates or maybe a perceived increase in safety, capital can rapidly flow out of other markets and into U.S. bonds, affecting yields everywhere.
Got it.
Beyond just capital flows, global economic sentiment plays a huge role. If there's a general sense of optimism or pessimism about the global economy, it influences investor behavior across all markets.
Everyone gets nervous together or hopeful together.
Something like that.
Yeah.
Furthermore, central banks, while independent, often observe each other's policies and global trends. If the U.S. Fed is cutting rates, it often creates an environment where other central banks might also consider easing their own monetary policy.
To stay competitive.
To maintain competitive currency valuations or stimulate their domestic economies? Yes. This leads to a kind of coordinated downward pressure on yields globally.
Okay.
So while each country certainly has its unique local dynamics and fiscal health, they are all part of a larger global financial ecosystem where information, capital, and sentiment flow almost instantaneously.
Making it hard to separate local from global.
Exactly. The global search for yield often means that the tide of major central bank policy lifts or lowers all boats, even if some boats have more structural leaks than others.
Okay, that global plumbing analogy really helps make sense of it. Speaking of global connections, the yen had a bit of a rebound. It hit a 148.0515 per dollar in New York trading, appreciating by about 25 cents.
A noticeable move for the yen.
This was largely due to dollar selling as expectations of a Fed rate cut in September intensified, narrowing that U.S.-Japan interest rate differential you mentioned.
The differential narrowing is key there.
But against the euro, the yen fell slightly. Here's where it gets really interesting. Yen selling was initially dominant because of Japanese political instability.
Ah, the domestic factor.
Yeah, LDP Secretary General Moriyama Hiroshi's resignation announcements and moves to oust Prime Minister Shigeru Ishiba, like Aso's support for an early leadership election. This uncertainty still seems to be a negative factor for the yen, so we're seeing these conflicting pressures.
Indeed, the striking element here is the dual, almost contradictory pressures on the yen. It's creating a real currency tug of war.
Tug of war, yeah.
Let's first delve into that interest rate differential. For our listeners, it's worth diving into how even marginal shifts in this spread, especially given the diverging policies of the Fed and the Bank of Japan, can create such powerful currency movements.
Okay.
Historically, Japan has maintained very low, near zero interest rates compared to the U.S. This wide differential encourages investors to borrow in yen cheap money and invest in higher-yielding dollar assets.
The carry trade.
That's the famous carry trade, yes. When U.S. interest rates are expected to fall, the anticipated return on those dollar assets decreases, narrowing that differential.
Making the carry trade less attractive.
Exactly. This makes yen-denominated assets relatively more attractive, prompting investors to unwind their carry trades, sell dollars, buy yen, thereby strengthening the yen. It's a fundamental driver, and the market reacts almost immediately to even a hint of a change in that differential.
But the politics interfere.
However, as you rightly point out, domestic political instability creates a powerful counterforce that can easily override those economic signals. Political uncertainty in Japan, particularly the potential for a leadership change or significant shifts in government policy.
That makes investors nervous.
Incredibly nervous, both domestic and international investors. They might worry about sudden policy pivots, for example. A new leadership pushing for more aggressive fiscal expansionary policies that could lead to ballooning government debt and, consequently, a weaker yen.
Or just uncertainty itself.
Or simply the uncertainty of a potential power vacuum in effective governance. These concerns lead to yen selling as investors seek stability and clarity elsewhere.
So two forces pulling opposite ways.
Exactly. We have the external factor of U.S. rate cut expectations strengthening the yen by narrowing the interest rate differential, and the internal factor of political uncertainty creating a weakening bias. The market is constantly weighing which force is more dominant at any given moment, making the yen particularly volatile right now.
So what happens if Japan gets new leadership?
If a new Japanese leadership were to pursue dramatically different fiscal or monetary policies, for instance, that could quickly reignite significant yen selling by increasing concerns about the national debt and its long-term impact on the currency.
So if the Fed cuts rates, the yen gets stronger. But if Japan's politics are shaky, the yen gets weaker. Which force wins out? And what specific indicators should our listeners watch for to anticipate the direction of the yen? It feels like trying to predict two opposing magnets.
That's an apt analogy, and it's precisely the challenge for currency traders. In the short term, immediate economic data and central bank policy expectations from a major player like the U.S. Fed tend to have a very strong, almost knee-jerk impact on currency markets.
So the Fed news gives the yen a boost now.
Yes, the expectation of Fed rate cuts provides a significant, immediate tailwind for the yen. However, prolonged or severe political instability can erode long-term investor confidence.
That could override the Fed effect.
It can ultimately overpower those short-term economic impulses, leading to a more sustained depreciation of the yen.
So what should we watch?
To anticipate which force might win out, our listeners should watch for the duration and intensity of each factor. For the Fed's influence, look at the consistency of subsequent U.S. employment reports and inflation data. Further weakness would provide persistent support for Fed rate cuts, and thus, the yen.
Okay, so keep watching U.S. data.
Yes. For Japan, the key is political clarity. Watch for the outcome of the LDP leadership dynamics. Any specific policy outlines from potential new leaders, any indication of how these might affect Japan's fiscal health or the Bank of Japan's monetary policy stance.
Like a big spending plan.
For instance, if a new government signals a massive fiscal stimulus package, that could trigger substantial yen selling due to concerns about increased debt. Conversely, if political stability is quickly restored and policies remain consistent,
Then the Fed effect dominates.
then the economic forces from the U.S. Fed would likely take precedence again. It's a continuous weighing game, and the market pivots rapidly as new information emerges on either front.
Okay, let's shift gears to retail. We're seeing some really stark contrasts here, and tariffs seem to be playing a significant, albeit nuanced role again.
Yes, the retail landscape is certainly showing some divergence.
Macy's, the iconic department store, actually surged an impressive 21.7% today.
That's a huge move for a company like Macy's.
After raising its full-year earnings forecast for the January 2026 period, their May July sales hit $4.812 billion, comfortably exceeding market expectations. And same-store sales even increased by 0.8%.
Against expectations of a decline, right?
Exactly. Contrary to an expected 0.5% decline. That's their highest growth in 12 quarters. This was led by 125 stores focused on staff increases and reforms, and their upscale Bloomingdale's also saw its fourth consecutive quarter of same-store sales growth.
Bloomingdale's doing well makes sense in this context.
Yeah, management highlighted strong performance from high-income customers, approximately half earn over $100,000 annually, and a surgical approach to tariffs, carefully raising prices for some products.
What this Macy's story truly highlights is a profound insight into market segmentation and the growing divergence in consumer spending.
So.
Macy's isn't just surviving, it's thriving by effectively targeting affluent consumers. These high-income segments are generally far less sensitive to inflationary pressures or economic uncertainties compared to middle and lower-income households.
Okay, so their customers aren't feeling the pinch as much.
Right. This allows Macy's to maintain strong sales, particularly through its Bloomingdale's brand, which serves a premium clientele. The key takeaway for investors here is that a company's ability to maintain pricing power, especially with an affluent customer base, is becoming a critical differentiator in today's, well, bifurcated economy.
And the surgical approach to tariffs.
That isn't just clever pricing, it's a testament to a sophisticated understanding of their brand power and customer base, instead of blanket price increases, which can alienate customers.
They're being selective.
They're selectively identifying products where demand is robust enough to absorb slight price adjustments without significant deterrence, or where they have enough brand loyalty to justify the premium.
Okay.
This targeted approach allows them to manage the impact of tariffs on their margins while preserving customer loyalty where it matters most. It shows that in an inflationary environment, companies serving the higher end of the market have more flexibility and resilience.
Which is very different from what others are seeing.
It starkly contrasts with the broader retail struggles we're seeing, suggesting a kind of two-speed economy where the affluent continue to spend while other segments pull back.
So the wealthy are still shopping, and Macy's is doing well. Does that mean the economy is only good for some people and not others? It sounds a bit like a two-speed economy, which is, well, a bit unsettling for many.
Your observation of a two-speed economy is not just astute. It's precisely what Macy's performance, when you put it next to other economic indicators, powerfully suggests. When we see consumption characterized as flat or decreased in the broader economy, like the Beige Book reported, and then Macy's and Bloomingdale's are thriving among high-income consumers, it paints a very clear picture.
A divided picture.
Economic health and resilience are not evenly distributed. The affluent segment, often less impacted by wage growth lagging price increases and possessing stronger balance sheets, continues to drive demand for higher-end retail and discretionary spending.
Okay.
This creates a distinct divergence. One part of the economy, buoyed by robust financial health, remains resilient and continues to fuel growth in certain sectors. The other part, comprising middle and lower income households, is struggling with tighter budgets, diminished purchasing power, and increasing sensitivity to price.
So it has big implications.
The very significant implications, not just for retail, but for overall economic stability and even social cohesion. It challenges the notion of a uniform economic recovery or slowdown. It underscores that policy responses and investment strategies need to acknowledge and address these vastly different economic realities experienced by various segments of the population. It really highlights a widening gap in economic comfort.
And on the flip side of that retail coin, we have Dollar Tree. Their stock fell a significant 11.9% after its October revenue outlook fell short of market expectations.
A sharp contrast to Macy's indeed.
Despite actually having strong May-July results, their revenue was up 12% in Q2, same-store sales up 6.5%, and EPS beat expectations.
So the past was good, but the future looks tougher.
Exactly. Management specifically mentioned a key headwind: the gradual reduction of inventory purchased before tariff increases.
The inventory buffer is running out.
Yeah. They noted that tariff cost reduction measures were realized earlier in May-July, essentially delaying the impact of increased cost burdens, but now those pre-tariff inventories are running out. They also warned of a slowdown in same-store sales growth.
This is a textbook example of how tariffs can create significant and, importantly, delayed headwinds, particularly for value-oriented retailers like Dollar Tree.
Why them especially?
Their business model is built on affordability and high volume. This means they operate on much tighter margins compared to luxury or even mid-tier retailers. Every cost increase, no matter how small, has a magnified impact on their profitability.
Okay.
What Dollar Tree experienced was a temporary, albeit beneficial, buffer. They had substantial inventory purchased before the tariff increases were fully implemented. This allowed them to keep prices stable for a while.
Which helped their Q2 results.
Exactly, maintaining their value proposition and contributing to their strong May-July results. However, as that pre-tariff inventory depletes, they are now facing the full brunt of higher import costs.
And they can't just raise prices easily.
For their highly price-sensitive customer base, passing on those increased costs directly can immediately lead to a drop in demand. That impacts their same-store sales growth,
Which is a key metric.
a critical metric for any retailer. It indicates how well existing stores are performing year over year. A slowdown here is a direct signal that either fewer customers are shopping or they're spending less per visit. That directly hits profitability for a business built on high volume and low prices.
So it really highlights their vulnerability.
It starkly contrasts with Macy's, which has the luxury of a more affluent customer base and greater strategic pricing power to absorb or selectively pass on tariff costs. It underscores the vulnerability of value retailers to these kinds of cost shocks.
It's so confusing. One company, Macy's, is raising prices, and another, Dollar Tree, is getting hurt by higher costs. For our listeners who are trying to make sense of this, how can tariffs be both a factor in Macy's surgical approach and a major headwind for Dollar Tree? It feels like the same external force is creating such different outcomes.
That's where the nuance and the fundamental differences in business models become absolutely critical. Tariffs are an external cost, yes, a tax on imports, but their impact is not uniform across all companies.
Okay.
For Macy's, with its higher income clientele and a product mix that often includes more premium or branded goods, a surgical approach to raising prices is feasible.
Because their customers can handle it better.
Their customers have greater disposable income and are often willing to pay a premium for quality or brand. Macy's also likely has greater flexibility in its supply chain and, importantly, deeper margins to absorb some of the tariff costs without immediately passing them all on.
So they have more room to maneuver.
They can choose which products to adjust prices on, minimizing customer pushback. Dollar Tree, on the other hand, operates on the principle of extreme affordability. Their entire brand promise is low prices. Their customer base is highly price sensitive. Even small price increases can lead to a significant drop in sales volume. Furthermore, their supply chains might be more heavily reliant on imported goods from tariff-affected regions, and they have very thin margins.
Giving them little room to absorb costs.
Very little room. For them, tariffs are a direct attack on their core value proposition and profitability. So the same external force tariffs acts like an uneven economic pressure,
Hitting different companies differently.
hitting different companies and consumer segments with varying degrees of severity, amplifying existing market dynamics. It's not about the tariffs being universally good or bad, but rather how specific businesses are uniquely positioned or unfortunately vulnerable to absorb, mitigate, or pass on those costs. It truly shows the bifurcation of economic impact we talked about.
All right, let's turn our attention to the volatile world of commodities. We've seen some dramatic movements today. Gold futures, for example, have been on an absolute tear,
Gold has certainly caught a bid.
rising for the sixth consecutive day. The December contract on COMEX was up 1.2% to $3,635.05 an ounce, briefly hitting $3,640.01. This marks a record high for the main contract for the second consecutive day.
Record highs grab attention.
And for domestic futures, it's the fourth day. This is a serious rally. What's driving this precious metal frenzy? Well, falling long-term interest rates in the U.S. bond market have made non-interest-bearing gold more attractive.
The opportunity cost argument.
Plus, the weak U.S. employment data we just discussed, the JOLTS report, is fueling expectations of a September Fed rate cut. Even concerns over Federal Reserve independence and U.S. fiscal worries are contributing.
A confluence of factors boosting gold.
And interestingly, in Japan, yen depreciation also boosted yen-denominated gold prices.
This gold surge is a classic, almost textbook illustration of gold's enduring role as a safe haven asset and its inverse relationship with interest rates.
Can you explain that relationship again?
Sure. For our listeners, it's important to understand the concept of opportunity costs here. Gold doesn't pay interest or dividends, unlike, say, a bond or some stocks.
Right, it just sits there.
Exactly. So when interest rates, particularly on U.S. Treasuries, are high, holding gold means you're giving up a significant, relatively risk-free return elsewhere. But when those interest rates fall,
The return you're giving up is smaller.
precisely, the opportunity cost of holding gold decreases, making it relatively more attractive as a store of value. The weak U.S. employment data we covered, signaling a potential economic slowdown.
That fuels rate cut hopes.
It intensified expectations of a Fed rate cut, meaning a period of potentially looser monetary policy. This typically benefits gold, as it can be seen as a hedge against potential currency debasement or inflation in such an environment.
Okay, and the safe haven part.
Beyond interest rates, gold's appeal as a financial security blanket truly comes to the forefront during times of economic uncertainty and fiscal concerns.
Like now.
When investors perceive a shaky economy, or if there's instability regarding government finances or the independence of central banks, they tend to flock to tangible assets like gold. It's a hedge against the unknown,
A store of value.
a universally valued asset that is less susceptible to the policies of any single government or the performance of any specific company. It's seen as a store of wealth that retains its intrinsic value when other assets might be depreciating.
And the yen effect.
And the yen depreciation in Japan adds another layer. When the yen weakens against the dollar, it simply takes more yen to buy an ounce of gold. So the price of gold in yen terms automatically goes up, making it appear more expensive and contributing to its record highs when measured in that local currency. It's a convergence of global economic signals driving this precious metal higher.
I love that analogy of a financial security blanket. It really resonates. So when everything else feels uncertain, people flock to gold because it offers that sense of stability and protection.
Yeah,
It makes perfect sense.
precisely. For centuries, gold has been seen as a reliable store of value. It's a finite resource that retains its intrinsic worth regardless of government policies or the health of any single economy.
Unlike paper money.
Well, when traditional financial assets like stocks or bonds feel risky due to economic uncertainty, inflation fears, or geopolitical tensions, investors often turn to gold. It's seen as a tangible asset that isn't subject to the same types of depreciation as fiat currencies or company earnings.
The currency of last resort.
You could call it that. A universal currency of last resort, a physical asset that provides a sense of stability and protection against the unknown. So yes, when people are worried, they often seek the safety and historical reliability that gold represents.
Okay. Meanwhile, crude oil futures on NYMEX saw a decline today. The WTI October contract closed at $63.97 per barrel, down $1.62 or 2.5%.
Opposite direction from gold.
Yeah. This was driven by speculation about expanded crude supply by major oil-producing nations. The OPEC Plus group is apparently considering additional production increases at its September 7th meeting.
Supply expectations weighing on price.
And concerns about a slowdown in the U.S. labor market also weighed on prices, as a weaker economy typically means less demand for energy. So gold up, oil down seems like diverging paths.
This is a classic demonstration of the powerful supply and demand dynamic in commodity markets combined with forward-looking market psychology.
How does the psychology work?
Well, even the speculation about expanded crude supply by major oil-producing nations, particularly OPEC plus S, can immediately impact prices, often before any official announcement. The market is constantly trying to discount future events.
Trying to get ahead of the news.
Exactly. If traders anticipate more oil hitting the market, they'll start selling futures contracts now, driving prices down regardless of whether the actual production increase has happened yet. It's all about expectations and the immediate balancing of potential future supply against current and future demand.
And the demand side.
The other critical factor, of course, is global economic health, and particularly the U.S. economy. Crude oil demand is highly correlated with economic activity.
Makes sense.
When the U.S. labor market shows signs of slowing, as indicated by JOLTS and the Beige Book, it raises concerns about overall economic growth. A weaker economy typically translates into less industrial activity, reduced transportation needs,
Less need for fuel.
and thus lower demand for energy. It's a direct connection. If factories are producing less, if fewer goods are being shipped, if people are driving less, then demand for crude oil decreases, which puts downward pressure on prices.
So both supply and demand pushing oil down.
We're seeing both supply-side expectations, potentially more oil coming, and demand-side concerns, potentially less oil needed working in tandem to push crude prices lower. That creates the divergence you noted from gold's performance.
The immediate expectation is that increased OPEC plus supply should, in theory, drive down crude prices and eventually gas prices. But as we know, commodity markets rarely operate in such a linear fashion.
Beyond the headline supply increase, what are the critical catches or secondary market dynamics that can complicate this seemingly simple equation for our listeners? That's an excellent way to frame it, acknowledging the inherent complexities. While in theory, yes, more supply should lead to lower prices, there are indeed several critical catches that complicate this seemingly simple equation.
Like what?
Firstly, the magnitude of the OPEC plus increase matters. Is it just a symbolic tweak, or is it a substantial boost to global supply? It needs to be significant enough to really offset global demand.
And demand isn't static either.
Exactly. Demand itself is a moving target, influenced by factors like economic growth in China, seasonal driving habits in the U.S., or unforeseen geopolitical events that might disrupt supply elsewhere.
Okay, so size matters. What else?
Secondly, there's always a lag time. Changes in crude oil prices don't immediately translate to gas prices at the pump. There's a refining process, transportation costs, various taxes at play.
It takes time to filter through.
It can take several weeks, sometimes longer, for crude price movements to fully filter through to refined products like gasoline.
Yeah.
Thirdly, market psychology is huge.
How so?
Sometimes, even a small production increase might be met with strong selling if the market is already bearish, negative sentiment. Or it might have little impact if underlying demand proves surprisingly robust, maybe better than expected.
Okay.
Finally, don't forget the refiners' margins and local market competition. Even if crude prices fall, refiners might hold on to higher margins for a while, or local supply issues could keep prices elevated in specific regions, regardless of the global picture.
So it's complicated.
So while the general direction, more supply, lower price, is usually predictable, the exact magnitude and speed of the impact on your gas tank can be quite complex, influenced by a myriad of factors beyond just the OPEC plus announcement.
Okay, let's shift our focus to Japan's corporate landscape. It has its own unique stories unfolding, and not all of them positive. Corporate governance is definitely under fire in some corners.
Yes, some concerning developments there.
Nidec, for instance, saw its stock hit the lower limit down, falling a staggering 22.43% to a 4.5-month low.
A massive drop. That signals serious trouble.
The company announced potential inappropriate accounting practices found in both the parent company and its group funds. Documents apparently suggested management involvement or awareness.
Which is particularly damaging.
Yeah. A Chinese subsidiary was implicated in mishandling a $200 million AED payment. A third-party committee composed of external lawyers has now been established for investigation.
Standard procedure, but it takes time.
And Nidec even missed its securities report deadline of June 30th, aiming for a September 26th submission, which analysts apparently doubt is feasible. This sounds like a complete breakdown of trust.
This Nidec situation is a stark reminder of the severe market reaction to accounting irregularities. They can completely erode investor trust. The critical insight here is that it's not just about the $200 million payment itself.
A bit bigger than that.
It's about the potential for systemic, inappropriate accounting practices and the alleged management involvement. This implies a fundamental breach of transparency and integrity.
What does inappropriate accounting mean exactly?
Well, it can range from deliberately misreporting revenues or expenses, manipulating asset valuations, to concealing liabilities. The market's limit down reaction shows how quickly and severely investors punish companies where there's even a hint of such practices.
Because you don't know what's real.
Exactly. It creates immense uncertainty about the true financial health of the company, leading investors to flee first and ask questions later. This scenario completely undermines investor confidence, raising significant questions about the robustness of Nidec's internal controls and, more broadly, corporate governance within the firm.
And missing the deadline makes it worse.
The missed deadline for the securities report only compounds these fears. It suggests deeper problems that are taking significant time to unravel and quantify. For investors, this kind of news is often a catalyst for a complete reevaluation of the entire company's risk profile.
That's a powerful signal of how quickly trust can evaporate. Moving to Brother Industries, their $20 billion stock buyback, represented about 4.3% of shares, failed to boost its share price. It actually fell 5% the next day and remained sluggish.
Interesting. Buybacks don't always work their magic.
This highlights a broader trend, where investors are scrutinizing the effectiveness of buybacks, especially when compared to much larger ones by competitors like Canon 100B and Seiko Epson 30B.
Size and context matter.
It seems there's a significant gap between corporate and investor views on shareholder return policies in Japan.
The Brother Industries situation really highlights a fascinating evolution in how investors view capital allocation, particularly stock buybacks, especially in Japan.
How have views changed?
Historically, buybacks were often seen as an easy win for share prices, maybe a quick way to signal a commitment to shareholder returns. However, the market, especially in Japan, is becoming increasingly sophisticated.
Investors are looking deeper.
They are. Investors are now looking for genuine value creation and strategic use of capital, not just financial engineering for its own sake. A small-scale buyback, like Brothers' $20 billion, especially one that doesn't significantly reduce outstanding shares relative to the company's market cap,
It doesn't move the needle much.
it can be seen as merely an attempt to appease shareholders without a clear, compelling strategy for growth or innovation behind it.
Okay.
This is why we see that significant gap between corporate and investor views. Companies might see a buyback as fulfilling their duty for shareholder returns, but investors are increasingly asking, is this the optimal use of capital?
Could the money be better spent elsewhere?
Could this money be better spent on R&D, market expansion, strategic M&A, or other investments that could generate more sustainable long-term returns and fundamentally enhance the company's competitive position?
Right.
The market is demanding a clearer alignment between management's capital allocation strategy and true long-term shareholder value creation.
And the bigger buybacks look better.
The larger buybacks from competitors like Canon and Seiko Epson not only dwarf Brothers in scale, but also send a stronger signal of conviction in their own valuations, making Brothers' effort appear less impactful by comparison. It's a sign that the era of simplistic buyback boosts might be over. Investors are demanding more thoughtful capital deployment.
That makes sense. It's like a company investing in itself. But sometimes the market wonders if it's truly the best investment compared to other opportunities. It really emphasizes the strategic role of capital. Now, let's look at some more positive stories of growth and efficiency in Japan.
Good idea. There's positive news, too.
Panasonic Holdings, for example, saw continued gains for the third day, up 1.32%. Nikkei reported plans to consolidate its Kansai logistics bases, aiming to cut annual logistics costs by $1 billion.
Efficiency gains are always welcome.
Then there's Fujikura, which continued to rise significantly, hitting an all-time high, up over 6%. It's more than doubled since the start of the year.
That's impressive momentum.
This is driven by active momentum buying and strong demand for optical fibers in AI and data centers. Analysts project a 23% operating profit increase for FY 2026.
Riding the AI wave directly.
And even China's new anti-dumping tariffs on some U.S. single-mode optical fibers might strengthen Japanese companies' price competitiveness.
An interesting geopolitical side effect.
Rigaku, a major analytical instrument maker, rebounded sharply, up 8.28% after Nomura Securities raised its target stock price.
Analyst upgrades can certainly help.
And SoftBank Group, SBG, rebounded after 3 days of declines, up 4.73%. A pause in global long-term interest rate increases, which are a headwind for high-tech growth stocks, was a tailwind.
Macro factors helping there.
And Alphabet's surge also boosted optimism, with increased AI demand potentially supporting SBG's performance and its subsidiary funds.
These are excellent examples of Japanese companies making strategic moves to improve efficiency or capitalize on burgeoning global market trends. Panasonic's logistics consolidation.
$1 billion saving.
It's a classic, albeit maybe less glamorous, story of corporate efficiency and supply chain optimization. In today's competitive global market, cutting costs through smarter consolidated logistics can directly boost the bottom line
Without needing more sales.
without necessarily needing to increase sales volume. This foundational type of operational growth is crucial for long-term profitability and resilience. It reflects a broader trend in corporate Japan to streamline operations and enhance productivity.
And Fujikura.
Fujikura's story is all about being in the absolute right place at the right time with a critical product. Optical fibers are the literal backbone of the digital age.
Especially with AI now.
Absolutely. With the explosion of AI and data centers, the demand for high-speed, high-capacity data transmission is insatiable. AI models require massive amounts of data to be processed, stored, moved.
And fibers carry that data.
Optical fibers are essential for that infrastructure. Fujikura's expertise in this niche positions it perfectly to capitalize on this mega trend.
And the China tariffs help them.
The geopolitical angle with China's anti-dumping tariffs is intriguing. By making U.S. optical fibers more expensive in China, it inadvertently creates a competitive advantage for Japanese companies in that market,
So they might gain share.
potentially driving more demand and better pricing power their way. It's a clear example of how geopolitical shifts can directly impact specific industrial sectors.
Okay. And Rigaku and SoftBank.
Rigaku's rebound, spurred by that Nomura upgrade, underscores the importance of expert analysis in identifying underlying value and future recovery potential. It shows that even if a company faces short-term headwinds, if the long-term outlook is strong, the market can recognize that.
Right.
Finally, SoftBank Group's rebound is directly linked to broader tech investment sentiment and global macro factors. As a major investor in high-tech growth stocks,
Their portfolio is sensitive to rates.
highly sensitive to interest rate movements. When long-term rates pause their rise or fall, it reduces the cost of capital for these growth companies, making their future earnings seem more valuable, boosting confidence.
And the Alphabet news helped too.
Alphabet's success further reinforces the positive sentiment around AI, which indirectly boosts SoftBank's vast portfolio of AI-driven startups and technologies.
So from efficient logistics to critical AI infrastructure, Japan seems to be making smart strategic moves. But for our listeners, is there a big picture trend here, or are these just individual companies' successes that we're seeing in isolation?
That's a truly perceptive question. And while these are individual company successes, I think they collectively point to several significant big picture trends that are shaping modern Japan.
Like what?
Firstly, there's a sustained push for improved corporate governance and increased capital efficiency. Companies are scrutinizing their operations more closely, like Panasonic's logistics move, trying to move away from past inefficiencies.
Okay, getting leaner.
Secondly, there's a clear emphasis on leveraging global technological advancements, particularly in AI and the digital transformation. Fujikura is a prime example of a Japanese firm providing critical infrastructure for this global shift, moving up the value chain. Thirdly, there's a strategic adaptability to geopolitical dynamics. China's tariffs, while creating global friction, inadvertently create opportunities for some Japanese companies to gain market share or enhance their competitive positioning.
Interesting.
Finally, there's a focus on strengthening niche, high-value areas like analytical instruments for Rigaku, where Japanese companies often have a strong competitive edge built on decades of expertise.
Okay.
So while each company's story is unique, they're all navigating and often benefiting from these overarching shifts toward greater efficiency, technological leadership in key sectors, and a more agile response to a complex global environment. It suggests a more strategically focused and resilient corporate Japan actively seeking growth avenues both domestically and internationally.
This next one is truly unique and completely unexpected, and I think it will resonate with many of our listeners who are pet owners. We're talking about catnomics.
Chuckles, catnomics. Yes, I saw this. It's fascinating.
Monthly spending on pet food in working households in Japan exceeded 1,000 for the first time ever in June. That's up nearly 60% from June 2020.
A huge jump in spending.
This is driven by the weak yen and rising raw material costs, pushing up pet food prices. Cat food CPI surged 31.1% compared to dog food's 13.7%.
Wow, a big difference between cat and dog food inflation.
Yeah. Catnomics, the economic effect of cats, is estimated to exceed $2 trillion in Japan. Cat ownership is rising, 9.155 million in 2024, up 9% from 2014, while dog ownership falls.
A definite shift in pet preference.
Pet-related stocks are performing well, but the rapidly rising prices might deter new cat ownership. Wait, cats are part of our economic indicators now. That's amazing.
Chuckles. Yes, indeed. Catnomics is a wonderfully relatable and surprising example of how deeply inflation can impact even the most niche markets and consumer spending habits.
It's not just big stuff.
It's not just about the big-ticket items like sofas or cars. It's about the daily expenses that accumulate and affect household budgets. The weak yen makes imported raw materials, think specialized fish, poultry, grains for pet food, significantly more expensive for Japanese manufacturers.
Okay, import costs again.
These increased costs, coupled with global supply chain pressures, are inevitably passed on to the consumer. The dramatic difference in CPI between cat food, 31.1% surge, and dog food, 13.7% surge, suggests a few things.
Like what?
Perhaps cat food has a higher proportion of imported ingredients. Or maybe the demand for cat food, given the rising ownership trend, is currently less elastic. People are less willing to cut back, allowing manufacturers more leeway to pass on costs.
Interesting.
The broader trend of rising cat ownership and falling dog ownership in Japan is also a fascinating socioeconomic indicator.
Why are cats becoming more popular?
Well, in an aging society with more dual-income households and often smaller living spaces, cats are frequently seen as easier and less time-intensive to care for compared to dogs.
Makes sense.
This cultural shift directly translates into significant economic impact, creating a thriving catnomics market worth trillions of yen, influencing pet supply chains, veterinary services, even pet insurance.
But the rising prices could hurt.
While pet-related stocks are performing well now, the warning about rapidly rising prices potentially deterring new cat ownership is very real. At a certain point, even the deep emotional bond with a pet might clash with the harsh realities of a household budget,
Forcing tough choices.
forcing people to reconsider or scale back on their spending. It's a vivid illustration that no corner of the economy, however beloved, is immune to the pervasive effects of inflation.
Chuckles. That's incredible. So next time I'm at the pet store debating between premium salmon pate and the generic kibble, I'll know I'm actually making a macroeconomic decision. Who knew my tabby was such a financial indicator? But if cat food keeps getting more expensive, won't people just stop getting cats or at least opt for cheaper food? That would totally change the catnomics equation.
You've precisely identified the potential tipping point and the intricate balance within catnomics. While the emotional bond with pets is undeniably strong, economic realities eventually set in, especially for discretionary spending.
Right.
Yes, if cat food continues its rapid price surge, we could see a few things happen. Firstly, existing cat owners, as you suggest, might indeed opt for cheaper food, switching from premium imported brands to more affordable domestic options.
Which affects companies differently.
Exactly. This directly impacts the revenue streams of different pet food companies and shifts market share. Secondly, prospective cat owners might, as you wisely point out, stop getting cats, or at least delay their decision, particularly if the initial and ongoing costs become prohibitive for their household budget.
Slowing down the trend.
This would inevitably slow the impressive growth of cat ownership, which is currently driving the catnomics expansion. It demonstrates that even in seemingly emotional markets like pet ownership, consumer behavior is ultimately tethered to economic viability and affordability.
Affection versus finances.
Inflation can certainly strain that delicate balance between affection and financial practicality, leading to real shifts in market dynamics.
From cats to consumption taxes, let's look at India. Indian stocks rebounded on September 3rd, with the Sensex up 0.51% on initial expectations of goods and services tax, or GST cuts.
Markets often react to expectations first.
But then on September 4th, scrutiny intensified after the GST Council announced maintaining only 5% and 18% tax rates, completely abolishing the 12% and 28% rates effective September 22nd.
So simplification and some cuts.
This means tax rates on durable consumer goods like ACs, TVs, refrigerators, and washing machines will drop significantly from 28% to 18%. And some foods and life insurance will also see reductions.
This is a classic market scenario where the initial positive reaction to expectations meets more detailed scrutiny after the actual announcement.
The devil's in the details.
Precisely. The initial rebound in Indian stocks was driven by the hope that broad GST cuts would put more money in consumers' pockets, stimulating demand across various sectors. What's compelling here is how these tax reforms can directly stimulate demand and significantly impact specific market sectors.
Especially for those big-ticket items.
By reducing the tax rate on durable consumer goods from 28% to 18%, the Indian government is effectively making these items 10% cheaper for consumers. This significant price reduction can be a powerful incentive for purchases,
Boosting sales for those companies.
boosting sales for manufacturers and retailers in those segments. It's a direct form of fiscal stimulus aimed at encouraging economic activity, particularly among India's burgeoning middle class.
Okay.
The market's initial enthusiasm was for the idea of cuts. The subsequent, more intensified scrutiny is now about the details and their specific impact on different industries. Abolishing the 12% and 28% rates while consolidating to 5% and 18% also serves to simplify the tax structure.
Is simplification a big deal?
It can be. The simplification can reduce complexity for businesses, making tax compliance easier, potentially improving the overall ease of doing business, and fostering a more predictable economic environment.
And the food tax cuts help budgets.
The reduction on some food items also has a direct positive impact on household budgets. So it's a multifaceted reform aimed at both stimulating consumption and streamlining the tax system, which could have a broad positive impact on the Indian economy.
So for the average consumer in India, these GST cuts are largely a good thing. But for listeners who might be wondering, why would they get rid of some tax rates and keep others? Why not just have one tax rate for everything? Is there a strategic reason behind this consolidation?
That's a very practical question. And broadly speaking, yes, for consumers in India, these GST cuts are overwhelmingly a good thing, especially for those looking to purchase durable goods, certain foods, or life insurance.
More purchasing power for them.
It means they will pay less tax on these items, effectively increasing their purchasing power for those specific categories. This is particularly beneficial for the growing middle class, for whom a 10% drop in price on a refrigerator or TV can translate into a significant saving.
Okay, and why not just one rate?
As for why they maintain some rates and abolish others, well, it's about striking a strategic balance. No government typically implements one tax rate for everything. Different goods and services have different social and economic implications.
Like essentials versus luxuries.
Exactly. Essentials, like basic foods, might be taxed at a lower rate, like 5%, or even exempted entirely to ensure affordability and promote social equity for all income groups. Luxury goods or items deemed less essential might traditionally face higher tax rates.
So it's about balance and simplicity.
By consolidating to 5% and 18%, India's GST Council is likely aiming for a simpler, more streamlined tax system that is easier to administer and comply with, reducing bureaucratic hurdles and potential for evasion, while still allowing for some differentiation between essential and discretionary items. It's a pragmatic approach to balance revenue generation, economic stimulus, and social welfare within a single tax framework.
Okay, lastly, let's touch on Japan's domestic market outlook and some other interesting issuances. The Nikkei average is expected to rebound, targeting around 42,100 yen, influenced by U.S. high-tech stock gains.
Global tech influence again.
However, domestic political uncertainty, with PM Ishiba's future up in the air, may dampen buying.
The political overhang we discussed.
Domestic bonds are expected to rise, with yields falling, again due to U.S. rate cut expectations. A key focus will be the Ministry of Finance's 30-year government bond auction.
Watching that option for sure.
And here's a truly specific one, which I find fascinating for what it tells us about microeconomies. Ready-mix concrete producers are expanding cooperatives, like in Kochi Prefecture.
Ah, yes, the concrete cooperative.
To boost price negotiation power with contractors amid declining shipments and worsening factory profitability, they're leveraging antitrust exemptions for SMEs. Prices actually rose by 3,000 per cubic meter in Kochi.
A very specific but revealing story.
We're also seeing an overview of planned bond issuances, including subordinated bonds from Chugan Financial Group and Euro-yen bonds from National Australia Bank, plus some TLAC-eligible bonds from HSBC Holdings.
You've highlighted some really critical forces at play in Japan, illustrating that constant push and pull between global and local factors. The Nikkei's outlook perfectly encapsulates this.
Oh, so?
It's benefiting from the tailwinds of strong U.S. high-tech stock gains, showing Japanese markets are not immune to global tech sentiment. but it's simultaneously grappling with significant internal political uncertainty surrounding Prime Minister Ishiba's future.
Politics holding it back.
Political stability is a huge factor for investor confidence, and any perceived instability can indeed dampen active buying, even amidst positive external cues. For domestic bonds, the expectation of U.S. rate cuts creating downward pressure on global yields is a dominant theme,
Pushing Japanese yields lower, too.
pushing Japanese bond yields lower as well. The Ministry of Finance's 30-year government bond auction is important because it's a key indicator of long-term borrowing costs for the government,
And investor appetite.
and a critical gauge of investor appetite for long-duration Japanese debt. The success or struggle of this auction can influence future government borrowing strategies.
Okay. And the concrete producers.
Now, the ready-mixed concrete producers. That's a truly fascinating microeconomic example. It offers a surprisingly clear lens into the broader regional economy.
How is concrete a lens?
This is a fundamental, localized industry often facing declining shipments and profitability, especially in an aging society with often shrinking construction demand, by forming larger cooperatives and leveraging those antitrust exemptions for SMEs.
They gain power.
They're pooling their resources and, crucially, their negotiation power. This collective action allows them to collectively raise prices, as seen in Kochi, which is essential for maintaining factory operations and the supply network, especially in regions with declining populations and construction activity.
So it's about survival.
It's a strategic survival mechanism for an industry that might otherwise face unsustainable price competition and widespread failures. It shows how, even at a very local level, businesses are innovating their strategies to cope with economic pressures. It highlights the resilience and adaptability required in challenging environments.
And those other bonds, TLAC.
Right. Regarding those bond issuances you mentioned, TLAC-eligible bonds are worth a quick note. TLAC stands for Total Loss Absorbing Capacity.
Okay.
These are a type of bond issued by systemically important financial institutions, like HSBC, designed to absorb losses in a crisis, thus preventing taxpayer bailouts. They're a key component of post-financial crisis regulatory frameworks.
Right.
The other bond issuances are simply the daily mechanics of capital markets, reflecting ongoing corporate and government funding needs for various projects and operations.
Ready-mixed concrete. That sounds so specific. How does a local industry strategy like that tell us anything about the bigger economy? Beyond just concrete, it feels like such a granular detail.
That's a fantastic question because this seemingly niche industry offers a surprisingly profound insight into the broader economic landscape. Think of ready-mixed concrete as a fundamental building block.
Literally.
Literally and figuratively, yes, for any economy. If an industry producing such a basic, essential commodity is struggling with profitability, facing declining shipments, needing to form cooperatives just to maintain pricing power and survive, well, it signals deeper issues.
What kind of issues?
It directly reflects the health of the construction sector, which is a major component of any economy. It might indicate sluggish public works projects, reduced private investment in new buildings and infrastructure, or even underlying demographic shifts leading to less development in regional areas.
So it's a bellwether.
So while it's a specific example, it acts as a powerful bellwether for underlying economic activity, particularly in regional economies that might not always capture national headlines. It shows that even foundational sectors are under pressure and must adapt, often through innovative collective strategies, which tells us a lot about the competitive environment and economic realities facing many businesses, not just those pouring concrete. It's a microcosm of the larger economic forces at play. #outro.
Wow. What a truly deep dive into the global financial landscape today. We've navigated the intricate world of tech giants, avoiding regulatory breakups and striving to profit from AI. The subtle but powerful dance between employment data and central bank policy. And even how inflation reaches into the most surprising corners of our lives, right down to our feline friends. It's almost dizzying to track all these moving parts. It really brings home the idea that truly isolated markets are, well, they're just a myth, aren't they?
Indeed it does. From the record highs in gold driven by interest rate expectations and that concept of opportunity cost, to the vastly different impacts of tariffs on diverse retail models like Macy's and Dollar Tree.
Right.
And even the strategic collective moves of a regional concrete industry in Japan.
Yeah.
Every data point, every corporate decision contributes to a much larger interconnected narratives.
Yeah.
Understanding the why behind these headlines and seeing how seemingly disparate events are linked is more important than ever. It underscores the profound interconnectedness of our global economy, where a decision in Washington or Tokyo can ripple through, well, potentially every household budget.
Exactly. And that narrative reminds us that while some things might seem isolated, they're often part of a much bigger economic story, full of both challenges and unexpected opportunities. It underscores the importance of staying informed, not just on the big numbers, but on the nuanced details that truly move the needle.
And it's those nuances that often offer the most surprising insights.
Absolutely. So as you reflect on today's deep dive, consider this provocative thought. In a world where even pet food prices are a bellwether for inflation,
Chuckle softly. Catnomics.
where geopolitical shifts can influence everything from optical fiber demand to long-term government bonds, and where the health of local concrete industries reflects national economic trends. What will be the next unexpected indicator that truly reveals the health of our interconnected global economy? Until next time, stay curious and keep diving deep.
Thank you for joining us on ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis. Goodbye for now.